There is a lot going on right now with the world politics and all this stuff going on with wars in Ukraine and wars with Pakistan and India right now. And I decided it was a good time to start looking at oil and gas stocks, ones that I always felt were interesting and that I'd even owned. I had owned this stock called Cactus, ticker symbol WHD, in my Roth IRA account, one of them. And I love the stock because they have a business model for the most part that I like. But as I dug in deeper into the company, being more prudent about the stocks that I own now because the market has been so rough, I decided that I'm going to go in there and dig deeper into all the companies that I owned. But that's a completely different story. We're talking about Cactus right now, and you need to know what you're getting into if you're going to invest in these oil and gas stocks right now. Because a lot of people are saying a lot of different things that are conflicting. And it all can't be true at the same time. So I'm going to go into this video about the stock and let you know what I think about this particular company, what they do, what they produce, what some of their numbers look like, and tell you what I think. Whatever you think, at the end of this, it's up to you. This is not investment advice. I am not a financial advisor. Do not make any financial advice based off the contents of this video. This video is entirely for entertainment purposes only. Seek professional help. I am just a guy on the internet, but I might have an opinion that might help you in your decision along with your financial advisor. Let's go. Now that we got that out the way, let's find out what they do. They're an oil and gas company, a market cap, $2.88 billion. See, me personally, when I invest in a company, I like to know that it has a market cap that it can grow into. If I was to buy an oil and gas company that's already like $200 billion with so much competition, I'm not sure if that company can continue to grow from 200 billion to 200 trillion. Like, I don't think it's possible for a company to do that. So I like to buy companies that are smaller these days for certain portfolios. I do own like Microsoft and Facebook because of different reasons, but companies that like this, that have so much competition that aren't that unique, I like, but they sell, they rent, and they do maintenance on their equipment. They're an official equipment manufacturer. They have a bunch of factories all over America, and they have 3 facilities. One's in Vietnam, one is in Australia, and one is in China. And therein lies one of the problems with the company with me. Because I'm bullish overall on the rental space. Like, I love rental companies right now because I think a lot of that inflation money is going to go to those companies because they have pricing powers. Companies can't afford to buy an entire equipment these days. It's not in the budget. It's going to mess up their numbers. Until they can find a way to become more profitable where they can sole source their own equipment and material, they'll always have that problem. So I think people are going to rent more and more and more because the value of it too, the logistics is something you just want to keep separate from your business and insulate yourself of. So you have these companies, you buy their equipment and you pay them to maintain it. So people that know what they're doing do the work the correct way. So that's the long and short of what the company does and how they generate revenue. So I like to base my company thesis on something that's actually tangible. So I chose the compound annual growth rate for the industry, the rental industry, to try to gauge and price the stock, to use it for evaluation of what I think the stock should be. So I have this printout here for you of the compound annual growth rate. 3.8 per year for the oil field equipment rental market size. So that's just that particular market. and how much I think the company can generate and steal of that market share and continue to steal of that market share. Who are their competition, and what is it in particular that they do that gives them an edge? And what it looks like in their numbers is that they have extraordinary returns on equity, returns on invested capital, and returns on capital employed. So they basically spend money to make money, literally better than large portion of the companies out there, because returns on capitals in the double digits is not typical for companies over long periods of times, at least. But with companies like these that are first movers, it's going to be difficult. It's the entry cost for someone to get into this business and start a business of their own is getting harder and harder it's very capital intensive to start a company like this. So they're insulated in a way. Right now, the price is $42.06. I lost money on the stock, by the way, because I sold it. I'm just going to give you full disclosure right now, but you got to stick the whole video to find out why I did that, because it's not as simple as that. Okay, so the 52-week range is 33.80 and 70. And PE ratio right now is 14.91. When I owned it, it was like 20. So I bought it overvalued. I did it completely wrong. Just to show you, I don't know everything. I'm learning still. I'm not the guru. I'm not a professional. So seek professionals when you watch these videos of anybody on YouTube that's not a financial advisor. But I put the analyst 1 year target because I used to ignore stuff like that. Like I didn't care about the analyst 1 year target before, but now I need to know what the bears think so I can counter my thesis and hear them out, because they're very intelligent people too, and they serve a purpose in the market. And I have to respect that. So after I did that, I just moved on to the next step. A lot of the best investors like companies that have certain attributes, and some of the best of them call them growth levers. The growth levers that they have are margins, returns, and free cash flow per share. Everybody uses different metrics, and they like different metrics about a company that enhance their view of how they think the company is running according to the financial statements. So me personally, I like companies that have higher margins, like 30 and above is ideal for me. Most of the companies I have are over at or above at 30. An operating margin, I like that to be in a reasonable amount, like 24%. And net margin, the amount of money that we capture after all the money that I spend, I like it to be in double digits at least. And the returns on equity, the return on assets, the return on capital, or return on capital employed, I love all those things, all of it. I love all of it to be double digits. I only own one company at the moment that have single digit returns in anything. That's how serious it is to me. And this company has it. This company has a lot of the attributes that I like in companies that I would spend my money on and buy and invest in and hold for years and years and years and have my kids own them when I can. The company has $2.98 of free cash flow per share, and the stock is trading at like $40. Like, it might look like the steal of a deal, but that's not the entire picture for this company. And I'll show you that right now. Yes, we have to go there. We have to go there. We have to talk about Trump's agenda. The president's agenda is to bring oil prices down so low that the cost of producing products is going to be so low that the prices is going to come down. That's what I think they're trying to do by making oil and gas go lower, by producing more right now. I think the country is getting ready to industrialize again for more reasons than one. But you got to watch my following videos for me to connect the dots for you, kids. I'm going to get better at making these videos and more comprehensive about it and more professional about it when I have more time. Right now, I'm just putting out stuff that I think is important for you guys to know at this point in my investing journey, what I'm doing, you know? But Trump is bringing down the prices of oil and gas, and the prices of oil and gas stocks have been crashing everywhere. I don't know many oil and gas companies that are doing very well right now. The consumers that are buying the products are doing better because the prices are coming down. The companies that are buying the products are buying them for more reasonable prices, so that's keeping the prices more stable. But the oil and gas companies right now are suffering. And there's only one thing I could think of that can improve that right now under our current circumstances, and that's industrializing and, of course, war. And we don't want to go there, but that's not the only thing that's crushing this industry right now as a whole. And I'll show you that right now. We got to talk about the $1.2 trillion Infrastructure Act. We got to talk about it because it's going to affect companies like this one. And it's going to affect them a lot. Whoever gets the money is going to have that extra money floating around on their balance sheet, and they'll be able to make better investments. As you can see, this company is very good at investing. They're extraordinary at investing compared to a lot of other companies, even though they're so cost intensive, But you got to pay attention to what's going on with the Infrastructure Act, because if you don't pay attention to what's going on with the Infrastructure Act, then you're going to miss a lot of what's going on and what's happening. I haven't heard the administration cancel it yet or anything like that. So I think it's still running right now. But that's a factor, a huge factor. $1.2 trillion is a lot of money, even for the oil and gas industry. I don't know the exact numbers of what it's worth right now, but I know it's a lot. But 1.2 trillion still isn't going to be a drop in the bucket. But let's move on. But let's first talk a little bit more about the parallels between the oil and gas rental industry and United Rentals, for examples. United Rentals is up 372% in the last 5 years. And right now, United Rentals, ticker symbol URI, they are only down like 4.5% on the year. But Cactus is down like 30%. So obviously it's not the rental industry that this is affecting. It's something else. It's something more that's causing this company to buckle right now. And what exactly it is like we need to figure that out before we even continue investing or invest even more money into the company. So just follow the bouncing ball. You're going to like this. Is the company resistant to tariffs? Well, first of all, they just acquired a new company, Flex Steel Technologies. And as you can see here from this clip out I have, the screenshot, they won an award for doing the acquisition. So like I said, they're extraordinarily good at finding nice bolt-on acquisitions and applying money where it needs to be applied. That capital allocation is amazing with this company. That's one of the things I was initially attracted to it for. And listening to the earnings calls, listening to the CEO, like he's a no BS type of guy. He's a guy that does what he says and says what he does. Like there's no BS in this man. And last earnings call I listened to, one of the analysts asked him like if he was going to distribute the cash that he still had on a balance sheet after this acquisition. And he was like, that the last time you asked me that, like I told you that I know what's best to do with the money. And if I knew that I didn't have anything to do with it, I would have already returned it to the shareholders. So he is not playing around. This man is amazing at what it is he does. But let's talk about a little bit more of the positives of the company before I get to my final conclusion. So these are some of the bonuses of the stock in addition to some of the bad things I already told you about. They've authorized a share buyback of 4.7% of the float, $150 million out of what is now a $2 billion market cap. That is a lot of money to pour on top of such a small company. Like, you cannot deny that that is a lot of money. They're cashed up, $303 million in cash, and they will still have $150 million after they do, if they bought back all 4.7% of the float. And they only have 41 million in debt as of the making of this video. And what's their total addressable market? The entire world. They can sell this stuff to the entire world unless our country says that they can, or the buying country doesn't want to buy. Like, they have a lot of competition, but the way they operate and how smart they are with their money, they have a shot. In conclusion, I got to say that I really like this stock. If I were to buy an oil and gas company, I wouldn't want to buy just a one-trick pony. I wouldn't want to buy a company that's so cost intensive that they're drilling and doing all that extra stuff. I don't like all that cost intensive, and then there's permits and all this other litigation and environmental types of damages could happen that could cause to the company. Like, this company does have its own set of liability and risks, but I think that it's less than a lot of other companies. However, I don't like the exposure to China. A large quantity and majority of their raw materials to make the products that they manufacture come from China. That's what I don't like about the business model, and that's why I suspect that the stock has collapsed. But just because the stock has collapsed now, and I mean, they have factories in Australia, which is also mineral rich, and they have in Vietnam, which is cheaper to manufacture things over there. And we're still friendly with America as far as I can tell. I mean, that's the only thing I do not like is the China exposure. They didn't source their products and their raw materials from enough places to be insulated from something like this. And that's the reason why the stock has collapsed. But I think they have a strong chance. And even though I think they have a strong chance, I'm out. I sold the stock. I already told you earlier in this video, spoiler, I already sold the stock, and I won't hold it now until I have some type of confirmation from the company that they're back on track and they have some type of armor against these type of threats. Because a lot of the other threats, I know that they exist already, but threats like tariffs, like the only threat I want to know about that is the unknown. Like what happened with COVID. Like, we never knew that would happen. But even now, I tend to buy companies that would do decent even in those types of situations where it's essential that these companies must exist and these companies must operate, or the entirety of civilization just crumbles. And that's my conclusion to the video. If you've made it this far, man, thank you so much for staying, and I appreciate it. Give me a like, a follow, a subscribe if you like my content, and stick around. I'm going to make more videos in the future, so don't miss one, man. And check out my other videos I have up already. I have some decent videos up here with some decent information that might interest you. Peace.